The IRS does not send all notices and letters via certified mail, but the ones that it does send via certified mail are generally pretty darn important. So in this video, I'm going to talk about the 5 most common notices and letters that the IRS sends via certified mail and tell you what you should do if you've received each one. But first, why the heck does the IRS even send some stuff via certified mail and send other stuff not via certified mail? Well, the answer is, in many cases, is that for some particular notices and letters, the IRS is actually required by law to send them via certified mail. It's true. For example, IRS code 63331 little d, not a big D, little d, says, or it requires that the IRS give a taxpayer at least 30 days notice before levying them, okay? Before taking their, levy means seizure, taking their stuff. So they're at least 30 days before the IRS levies their salary or wages, that's a bank garnishment, or any of their other property, commonly a bank levy, right? Just zapping money right out of your bank account. At least 30 days before the IRS does that, it has to give the taxpayer notice of their intent to levy. And check this out. This notice must either be given in person, left at their home or usual place of business, right? Or, and this is the option the IRS generally takes, sent by certified or registered mail to such person's last known address, no less than 30 days before the day of the levy, right? So in this case, this is the law. This is the actual law here. This isn't just IRS policy. This is the law, part of the United States code, the United States Tax Code, 6331, Section 6331, says the IRS has to give sufficient notice to a taxpayer of the IRS's intent to take their stuff, right, if they owe the IRS money. And that notice must be delivered in person, left at their dwelling place or their typical place of business, or sent by certified mail. And which option do you think the IRS typically takes? Yes, the option they typically take is sending by certified mail. Oh, and by the way, a typical notice that the IRS sends to satisfy that requirement in Section 6331 of the tax code is the CP504. And I'm actually going to talk about this notice later in this video. So like I said, there are other notices that the IRS sends via certified mail than the 5 I'm going to talk about now in this video. Okay, for example, the CP91. The notice of intent to levy your Social Security benefits, right? Because yes, the IRS can garnish your Social Security benefits. They will send that notice via certified mail, right? There are many other notices and letters the IRS sends via certified mail other than the ones I'm going to talk about in this video. I'll probably make more videos on those other notices at some point. But right now, let's just talk about the 5 most common notices and letters the IRS sends via certified mail. And folks, the only way you're going to know if you received one of these notices or letters is if you open the envelope and look at the actual notice or letter, right? Because in the top right, you can see the notice number, okay? Well, let's just use the CP504, right? It'll say right there, notice CP504, right? That's how you, or in this case, the LT11. That's how you know what notice you're looking at. Oh, one more thing before I get into the notices themselves. The IRS is going to send these notices to your last known address, okay, which is the address used on your last filed tax return with the IRS. So if you haven't filed a few years of tax returns and you've moved since you've last filed a tax return, these notices might be going to an old address, right? Unless you file a new return with your current address or you have filed Form 8822, change of address with the IRS. But the easiest way to change your address with the IRS is to simply file your tax returns. Okay, now let's talk about the 5 most common notices that the IRS sends via certified mail. Okay, so the first one is the CP2000. I'm sorry that this one is kind of like messy here. I usually get notices, like sample notices from the IRS, but the sample notice that the IRS gives for the CP2000 is like not relevant. It's like not the most common situation that people get CP2000. So I just pulled one of our clients' CP2000s. I redacted the sensitive information like Social Security number. I mean, I just pulled one that we've been recently working on, okay? I probably could have found a neater one than this one, but this is just a case we've been working on recently. So it was just top of mind. Anyway, the CP2000 is a notice of proposed adjustment for underpayment or overpayment. So basically, the IRS sends the CP2000, and you can see, ooh, what did I just do? You can see it says, CP2000 right up here. That's how you know it's a CP2000. Basically, the IRS sends this notice to a taxpayer if there is a discrepancy between the income reported to the IRS, like on a W-2, 1099, K-1, whatever, and the income that the taxpayer reported themselves on their own tax return. We see this all the time with 1099s, okay? Taxpayer files a return and did not include a 1099 on the return. Now, sometimes it's not even their fault. Well, in a sense, it's not their fault, right? Because what many people do is they have a 1099, side hustle or a little business that they have. They don't really keep books and records, right, too well, so they just depend on the 1099 that they get to do their tax returns. They should be keeping their books and records, right? Separate bank account. That's the official correct way to do it. But some folks don't. It's just like, okay, I'm going to gather all my tax documents, input in my tax software, and that's it. And sometimes a 1099, right? Maybe the person who paid them the money, right, as an independent contractor didn't even send them a 1099 or sent that 1099 to a wrong address, right? And that's why the person didn't put it on their tax return. Nevertheless, the IRS still blames the taxpayer, right, for that. And so what the CP2000 is basically saying, like in the case of this example client here, this client here of ours did not include some 1099 income on his tax return, right? Again, I apologize for the quality of this image, but the IRS is saying, look, according to our records, we have record of it that you receive a 1099 for $7,365, okay, and another one for $16,315. That's what we see, right, for a total of $23,000. But you didn't report any of this on your tax return. So what are we, IRS, going to do? Well, we recalculated your tax return for you, right? You can see that here. Changes to your 2020 tax return. Shown on return, this is what you reported, taxpayer. But this as corrected by IRS is what we think it should have been, okay? And in this case, there's an additional $7,724 of taxes on the tax return that the IRS believes the taxpayer owed, and then plus penalties and interest, right, which they tack on. They're looking at $9,875 bill. Okay, so that's what a CP2000 is doing. Okay, it's saying, look, there's a discrepancy between what you report on the return and what we see, we being the IRS, what the IRS sees in their records. Okay, and now we're proposing this adjustment. It's not final yet. You'll notice that the CP2000 uses this word, proposing. Okay, we are proposing changes to your 2020 form tax return. Okay, this is not a bill. Okay, we're simply saying, look, something looked off, and here's what we're proposing. Right, we're proposing that we're going to include all this as income on your return, and if you don't respond to it, or you don't say, hey, yeah, actually, I did earn that income, but I also had all these deductions against that income too, which you probably did, then they're just going to assess this liability, right? And they'll send you more certified mail before they do that. I'll talk about those notices in a bit, right? But the best thing to do when you get a CP2000 is first, review it for accuracy, make sure it's accurate. And then, if it is accurate, if you did actually forget to report this tax document on your return, are there any actual expenses you can take against this income to lower your liability from what the IRS thinks it should be? Because the IRS is just going to assume, right, that you didn't have any expenses or deductions against this income that you didn't report on your return, right? But if it's a 1099, you probably had some legitimate business expenses you could take against it, okay, to lower your tax liability from what the IRS is proposing. Or maybe the CP2000 is wrong. I've seen it where IRS sends a CP2000 for a duplicate 1099, right? Where the taxpayer did report the 1099 on their return, but the IRS, for some reason, sees two 1099s for the same amount in their system, and they're looking for the other one, right? When really it's a duplicate, you just have to kind of explain that away to them. So if you're gonna but if it's the first case, which is more common, where yes, you just forgot to input this amount on your return, but you do have valid deductions to take against that income, you have options. You could simply submit the tax form. It should have gone on to the IRS, for example, if it's a Schedule C, right? Submit the Schedule C to the IRS that you should have filed, right? Showing the income on the 1099 plus all your, and then below that, all your business expenses and all the other lines, right? You could do that. Or you could just simply file an amended return with the IRS. We like that approach better because it's more complete, right? And the tax is all calculated there and everything. So we actually typically go that route for our clients if that is the case. But look, if now the third possibility, I guess, here is that you have no expenses or anything to claim against the income. And it's like, yeah, you actually just forgot to include this tax document on your return, and the IRS caught you, right? Or corrected you, I guess is the better term. And if that's the case, you can, you owe this money, might as well not drag it on. You can consent to the proposed assessment, and it's on a page here at the back of this thing. Right. You can, if the IRS is right here, right, you just didn't include it and you don't have any expenses to claim against it, you can, just check the box. I agree with all changes, right? Sign it. If it's joint return, sign it. Your spouse sign it, date, and return it to them. Okay. And then you have options. Or well, what you could do is you could just wait it out too, right? You can wait for the 92 or the 90-day letter, right? The 3219A that I'm going to talk about next is another notice the IRS sends via certified mail. Just wait it out. They'll eventually assess it, right? Or if you want to speed things up, you can sign the box or check the box and sign it to consent to the changes. But whatever the case is, if this CP2000, right, whether it's correct as is, the proposed assessment is correct as is, or whether you have additional expenses to take against the income that was not reported, you have to figure out what you're going to do with this extra tax liability and penalties and interest, right? If you have the cash to pay it off now, great. Go ahead, do that, right? You'll minimize penalties and interest. If you don't have the cash to pay it all off now, as most of our clients don't, well, then you have to look at some kind of tax resolution option, some kind of tax relief option. Okay, describing these options in full is not the focus of this video. That's what I usually talk about on this channel, but it's not the focus of this video. So you can look at the rest of my channel for the tax relief options that are available to you, possibly. Offers and compromise. As a settlement with the government to settle your tax debt for less than you owe. A partial payment installment agreement. That's an agreement to pay the IRS less than you owe over time, with you paying them an amount every month until the tax debt drops off. You can't afford to pay them anything. C&C, currently non-collectible status, also known as hardship. Right? That's a special status with the IRS that they place you in because you've proven to them that you can't afford to pay them a dime. Right? And you stay in that status, and theoretically, if you stay in that status until your tax debt falls off, then you won't have to pay them anything on that debt. Okay? Want to learn all about all these tax relief options? Check out the video at the top of the screen and in the description below on all the tax, debt relief, and forgiveness options that are possibly available to you. All right, so that's the CP2000. Okay, now let's move on to the next notice here. It is the CP3219A. Okay, now this is the IRS does send this via certified mail. This is the statutory notice of deficiency, also known as the 90-day letter, that the IRS will send to you if you do not respond to the CP2000. Okay, why is it called the 90-day letter? Because this letter informs you of your right to petition the tax court to contest the IRS's proposed assessment. And the deadline to do that is 90 days after the date of the notice, right? You see the day of the notice is June 19th, 2008. Well, 90 days after that is October 19th, 2008. And that is the taxpayer's last day that they have to petition the tax court to protest the IRS's proposed assessment from the CP2000. Now, in addition to petitioning the tax court, or instead of petitioning the tax court, you could simply file an amended return, right? Just like you could in response to the CP2000, or submit additional information to the IRS to consider, just like you could for the CP2000, right? But none of that changes the tax court thing, right? If you do all that, that doesn't extend your deadline to petition the tax court, Okay, that 9-day deadline is very, very fixed. But in most cases, right, if it's a very simple issue, oh, I forgot to include a 1099 for, $10,000, and I have, some business expenses to claim against it. Probably just find the amended returns the way to go. You don't have to go to tax court. But if you do not respond to the CP 3219A within the 9-day deadline, right, with additional information, or you amend a return, or you petition the tax court, then the IRS is going to assess the proposed assessment. So what it told you it's proposing, right, to assess you, it will then do that if you do not respond to the 3219A. Okay, so that's the 3219A. So those two notices I just described, those pertain, those are notices that are sent before the IRS assesses a tax, right? The CP2000, this is our proposed assessment, right? The CP3219A, okay, you didn't respond to the CP2000. Now we're going to send you this notice, this 90-day letter, to get your attention, right? But the tax has not been assessed yet, right? It's only if you don't respond to the CP3219A, the statutory notice of deficiency, the 90-day letter, that the IRS will then assess the tax. The next three notices I'm talking about are notices that take place after the IRS has assessed the tax. Okay, assessment means officially recording it on the government's books. Once the IRS has assessed the tax, then it can collect a tax. Okay, so the next few notices I'm going to talk about are post-assessment notices, and the first one I'm going to talk about, and I've already mentioned it previously in the video, is the CP504. Okay, so the CP504 is the notice that's referenced, or is a notice, one of the notices that can satisfy the requirement in Internal Revenue Code Section 6331D for the IRS to give a taxpayer at least 30 days notice before levying their assets, right? And this is a notice of intent to levy, right? Notice of intent to seize, levy, your property or rights to property. So this is basically the IRS saying, like, look, yeah, we've sent you, several other notices. Typical sequence: CP14, CP501, CP503, and now the CP504. You haven't responded to them. You haven't worked out any arrangements with us. You haven't resolved your tax debt. So now we intend to take your stuff, okay? Because you have not reached out to them to fix the situation or reach some kind of better resolution than the IRS simply taking all your money in your bank account and levying your wages. Right. So that's what this is. Okay. But even so, even if you don't respond to this one, there is another notice the IRS has to send you before it starts taking your stuff. Right. Well, first of all, what should you do if you get the CP504? Well, I would recommend you get into a resolution with the IRS. Right. Either pay off your debt in full, or submit an offer in compromise if you qualify, get into some kind of installment agreement that works for you, maybe even CNC status. Want to learn about what all those things are? Check out the video in the description below. Okay, link to the video there. Now, if you don't respond to the CP504, the IRS actually sends you another letter before it actually can start garnishing your wages and levying your bank account. Okay, and that letter is the LT11. Okay, you can see it right here, LT11. Now, this one fulfills the requirement found in Internal Revenue Code Section 6330 that says before taking levy action against a taxpayer, the IRS has to give them their CDP rights. Okay, CDP is collection due process. So the IRS has to inform the taxpayer of the right to request a collection due process hearing pertaining to the collection activity that the IRS is attempting to take against them. Okay, so this isn't just notice of intent to levy, notice of intent to levy and notice of your right to a hearing. Okay, so once you've received this notice, you basically have 30 days to either request a CDP hearing, okay, 30 days from the date of the notice, right, and use Form 12153 to do that. And it's generally advised, right, in most cases for our clients, if they're in the 30-day period after receiving the CP504. I mean, many clients are just the LT11 or the equivalent, right? There's other kinds of final notices, not just the LT11. LTs for if you're an ACS, it could be a 1058 if you have a revenue officer. There's other kinds of notice numbers too. But if they're in the 30-day period to request a CDP hearing when they come to us, which is often not the case, right? But if they are, we will generally request a CDP hearing. Okay, so that's generally the move. If you don't respond within 30 days, you can request an equivalent hearing. There's some differences there. But and sometimes we actually go that route, as a matter of fact, because the CDP hearing actually tolls the statute that the IRS's 10-year time limit to collect. The equivalent hearing does not. I mean, there's some other differences there. This is probably getting a little too into the weeds, but it's generally a good idea to request a CDP hearing if you're within the CDP period here. Okay, because what this will do is, well, quite frankly, it buys you some time, right, before the IRS starts taking levy action against you, because they can't take levy action against you during the pendency of the CDP and until the officer in the CDP hearing has made a final determination, right? And all a CDP hearing is basically your opportunity to argue your case to an appeals officer regarding why the IRS shouldn't start taking your stuff and that you qualify for something, perhaps a hardship-based resolution like an offer in compromise or a CNC or something like this. Okay. If you go for an offer in compromise, the appeals officer will not be the one to approve your offer in compromise. Okay. But this is basically giving you an opportunity to tell the IRS why they shouldn't start taking your stuff. Okay. And it's generally a good idea to go through that process because it does buy you some time. And just from a client service perspective, it allows, it kind of buys us some time before the IRS starts levying a client to kind of formulate our plan of attack, right? Like how are we going to argue this client's case to get the documentations we need, fill out the 433, right? Figure out what the best resolution is for the client. Okay. And of course the resolutions we're going for, the vast majority of cases, offer in compromise, some kind of installment agreement that works for the client, or CNC status. Okay. All right. Now let's talk about the last piece of IRS certified mail I want to talk about, and that's the letter 3172. Okay. Why does... I thought I got rid of all the blue, but I guess I didn't. Okay. So you'll have to live with the blue. All right. Letter 3172. Okay. What is this? In tax code section 6320, it says the IRS has to give a taxpayer a notice of when the IRS files a notice of federal tax lien against them. Okay, and that's what the 3172 does. Notice of federal tax lien filing and your right to a hearing under IRC 6320. Okay, so after, right, the IRS files a lien, not before, right? Because think about it. What does a notice of federal tax lien do? What does a notice of federal tax lien do? It puts the world on notice that you owe the IRS money and the IRS has a claim to your assets. Okay. So if you go to sell your house that you have $500,000 of equity in, but title company says, there's a lien on the house to the United States government for $300,000. Okay. That means that before you get anything out of that house, if you sold it, the United States government would get $300,000 first. Okay. And so, logically thinking, if the IRS told you in advance, hey, we're going to file notice of federal tax lien against you, what do you think people would do? They would simply try to sell their house before the IRS actually files the lien, right? Or they would try to maybe even transfer title in the house to a relative. Probably be fraudulent, but they would probably try to do stuff like that, right? So to avoid that, Congress, when it wrote the statute, said, unlike the levy where the IRS has to give them notice before the levy, with the lien, the IRS can file the notice of federal tax lien, but they don't have to give them notice until afterwards. And you can see the statute here, 6320, right? The Secretary, main Secretary of the Treasury, by extension of the IRS, shall notify in writing the person of the filing of a notice of lien, and this notice has to either be given in person, left at the dwelling or usual place of business, or, of course, sent by a certified or registered mail to such person's last known address, not more than 5 business days after the day of the filing of the notice of lien, right? So within 5 days, okay, within 5 days, 5 business days, the IRS has to give the taxpayer notice that they filed a notice of federal tax lien against them in state and or county records. And the letter 3172 also provides the taxpayer with their CDP rights. Okay. you must request your hearing by blank. This would be 30 days from the date of the notice. Please complete the enclosed form 12153, request for a collection due process or equivalent hearing, and mail it to. And there would obviously be the information here if this were an actual notice and not just a sample. So what should you do if you get a 3172? Well, same thing as you should do with the other post-assessment notices. Reach a resolution with the government pertaining to your tax debt. Okay? If you don't owe them too much money, sometimes we can get, if the taxpayer doesn't owe them too much money, sometimes we can just work out a payment plan, as a part of that payment plan, the IRS will withdraw the lien, right? That could be in the cards, right? If you submit an offer in compromise and it's accepted, and once you've made your final payment on an offer in compromise to the government, then the IRS must take away the lien within 30 days, right? So there are options here if you want to avoid a lien. Now, I will say that the lien is sometimes I want to be careful here because the lien is a serious thing. And it does have repercussions for bankruptcy. But I think sometimes taxpayers might take the lien a little more seriously than they need to, right? Because it really only affects you if you're planning. It can't affect other things, but for most taxpayers we talk to, it really only affects them if they have equity in an asset that they're looking to dispose of, right? Sell or take equity out of, cash out, like a refi or something like that. But if a taxpayer, they, let's say they're older, they do not intend to move in the future, or at least not before their tax debt drops off, it might not affect them very much. But if they are like really old, they're thinking about their heirs as well. So the lien's kind of an interesting thing, right? It's not a collection activity. It's not like the IRS like a levy reaching into your bank account and taking money, garnishing your wages. But it is a powerful tool the IRS has. How powerful it is for an individual taxpayer situation really depends, right? If someone's in real estate and they want to go, borrow and buy a lot of property, sell a lot of property or something, the lien's very important. The further away someone gets from having assets, or at least trying to convert assets to cash, the less significance that the lien has. So sometimes, in our resolutions with the government, there's no way to avoid the lien, and the taxpayer just has to live with it. But anyway, reach a resolution with the government, right? And file the CDP hearing as well would be a recommended course of action. So, all right, how long is this video? We're already into it for a while. So that, folks, those are the 5 most common notices and letters the IRS sends via certified mail. If you've received an IRS notice or letter via certified mail, please feel free to book a call with us. You can call our appointment line at 866-8000 tax. Fill out the form here. We will reach out to you, or you can click free consultation on our homepage there. Free consultation. It'll take you to a little calendar thing. You can book a free consultation. I do believe in educating people about this stuff because I think there's a lot of misinformation floating around out there. Please check out the left-hand side of your screen. I have other tax relief videos here. And see you in the next video, folks. Bye-bye.